All right, everyone. Thank you so much for being here today. We're so excited to dive into a topic that has a huge impact, not only in your business, but for your clients, especially those that are investors. Today, we're going to be talking about 1031 exchanges. As real estate professionals, it's important that we understand not just how to serve our clients in a single transaction, but how to help them build long-term wealth through real estate. And for investors, 1031 exchanges are one of the most powerful tools we can use to help them do that for so many reasons, but especially because it helps defer capital gains and strategically grow their portfolios. But as you know, they can get complex very quickly, from timelines to financing requirements, documentation. It is quite a process, and the more you know, the easier that process will be. So today we are so thrilled to have Investors Title with us. They are one of the first organizations structured specifically to handle 1031 exchanges. They've helped countless investors and agents alike navigate this process smoothly and successfully. So whether you are already working with investors or you want to be headed in that direction, today's call is the perfect stepping stone. Matt, thank you so much for joining us today. We're so excited to learn from you.
Well, thank you so much. And it's great to be with you this morning. And honestly, listening to the conversation before the recording started, that's wonderful for me to hear. I just love to hear the banter back and forth and talking about what is like-kind property. It doesn't have to be rental for rental. It can be, but it doesn't have to be. And talking about reverse exchanges, absolutely. That's my love language. So great to be here and look forward to having a great conversation with you this morning.
Absolutely. Well, the floor is yours. I have sharing turned on. Feel free to share if you have something on your screen, or we are just here to be an audience, whatever
Yeah,
works.
let's just have an audience, and we can certainly have a discussion too. So let's do cover a bit of the basics for those who have if 1031 is kind of a new lingo for you or something that you're just kind of discovering. Let's talk through and actually even though we're a day late for April 15th, I think it's a good time to talk to you about how I might couch what a 1031 like-kind exchange is to clients who have never heard of it before. You know, they're calling me for the first time going, Matt, somebody told me I needed to learn about this. What is a 1031 like-kind exchange? So since we're just done with tax season, this is kind of the way I would translate it. So let's say that we filed our taxes and don't laugh at me when I say this, but let's say we find out we're actually getting a return, okay? And we get all excited about the fact that we're getting money back from our tax return, and we kind of have that dual thought of, okay, do I use this money to go have fun with, or do I use this money to do something responsible, you know, pay off some debt or something? And then the actual realization hits us that, wait a minute, whose money did I actually just get back? And you're all shaking your heads. That's right. It was my money that the IRS has been holding throughout the tax year, basically. And so how much interest did they pay me while they were holding my money before they returned it back? Zero. That's exactly right. So how does that compare to 1031s? I say it this way. What a 1031 like-kind exchange does is this is the IRS saying, okay, you just sold a piece of property. And instead of paying us the tax on the gain from the sale of that property immediately or in that tax year, we'll let you defer it, and we'll let you keep the money that you would owe us normally, and we'll let you use that to reinvest into other property. And along the way, while you're holding those funds, you don't have to pay us any interest. That's kind of the way I look at it. Now, officially, what the IRS said is a 1031 like-kind exchange is this. If you're a taxpayer who owns real property, and that real property has been held for business or investment use, when you sell that piece of property, as long as you take the proceeds from sale and you roll those over into another piece of real property that, again, you would hold for business or investment use, then you would not have to immediately pay the tax you normally have to pay, which is absolutely wonderful, okay? So just real briefly, what are we talking about from a tax aspect? What taxes are we looking at deferring? And you can jot this down, don't have to memorize it. It's just a good point to kind of think about. So first off, we're able to defer the federal capital gains that we would normally have to pay. And that is either 15 or 20% based on the taxpayer's income. So right there is an immediate deferment of 15 or 20% of the tax that we would normally have to pay. Second, we're in North Carolina. We have a state capital gain, I think it's 4.8%, but the state capital gain is also able to be deferred through a 1031. So you're looking at, zero from Florida, Tennessee, and Texas up to 14% at a state tax rate that can be deferred. Now that's important because I don't know about you, but we certainly work with a lot of California clients who are selling a 2-3 ranch in California for 1.8 million, and they're coming here and buying 3 or 4 houses, and being able to defer that 14% or 13.8% state capital gains is huge for them. So federal, we have state. Third, we have this net investment income tax, which is 3.8%. That is deferred as well. And then finally, for those of you who are familiar with depreciation, again, the IRS is very, very kind in allowing us to depreciate, whether it's a commercial property or a residential investment. They allow us to depreciate that property X amount every single year over a period of years. And when we sell that piece of property, the IRS says, hey, we would like to have 25% of the depreciation we've allowed you to take back. So depending on how long that property has been owned, or maybe if they've had some accelerated depreciation taken on the property, there are times when that depreciation recapture tax can be the larger tax that they might defer through the 1031. Now, all said, what does that even matter? What it matters from the agent perspective in my mind is now you've got a client, number one, who you've helped sell a piece of property. And through the 1031, now they're able to save between 30 to 38% of the tax that they would normally have to pay on that gain, which means now they have additional equity to go back into that new property or multiple properties that you're going to help them find. And I think that is absolutely wonderful. If I can chime in on what was being said earlier, talking about what like kind is, right? So it's the 1031 like kind exchange. And one of the questions I get almost daily is, Matt, what does that actually mean? Because if you read it and think about it logically, it makes sense that, okay, if I'm selling a single family rental, like kind is obviously another single family rental, but wonderfully it's not. So it's any real property for any other real property. So it could be land, non-income producing land for now an income producing property. It can be a residential property investment for now a commercial property, or vice versa. As somebody said earlier, I can sell land and I can go into a C-store. I can sell a C-store and buy multifamily, sell a multifamily, buy a warehouse. Again, as long as it's classified as real property, and as long as it is being held for business or investment use, it's going to meet that like kind definition. And states don't matter. Okay, so land in Alaska is like kind to a rental condo in North Carolina. Okay, so we're not really worried about state borders either. So it really is a wide open playing field for folks, especially when you have people who are looking at changing asset classes. They're looking at moving from a more hands-on residential investment rental type property to something in the commercial arena that's triple net, mailbox money, things in that time of life where they're more focused on income and less hassle than they are, whoever was talking about earlier, kind of doing the monopoly idea with properties and swapping contracts and everything else being a constant daily reminder and effort. So it is it's fascinating, and the opportunity and possibilities are almost endless when it comes to the 1031s. So I want to take a break right there if I can. Does anybody have any questions or comments or anything that is kind of bubbling to mind? That was really for me just to take a drink of coffee. That's all that was. Not kidding.
I do
No.
have a quick question. I'm
Yes.
trying to wait because I always like to jump in and I like to give people a moment to do the same. So you guys pop it in the chat if something comes up. But one thing that I kept thinking as you were saying all of this that I'm curious about is obviously we're talking about capital gains here and deferring that tax. And so when I think of that, I also think of like when you go to sell your home, like the 2 years out of 5 years rule, when someone goes to purchase a property in a 1031 exchange, is it for perpetuity? It must be used for business and investment use, or if it's a single family home down the road, can they then also use it as personal use?
Oh, yes, they can. Absolutely. So let's talk about that because one frequent conversation is just that. Number one, Matt, how long am I supposed to own a piece of property before I can sell it and it qualifies for a 1031? And to be quite honest, this is exactly what the IRS told us. Absolutely nothing. Okay. They gave us no time frame, they gave us no holding period, but what they did say was very, very important. They said that intent matters. So they're going to look at day one, when you bought that property, what was your intention with it? Okay. Now, that leads to a lot of gray areas okay, I don't know if you know this, but a lot of people like to play in the gray areas of the tax code and see what they can either get away with or, just push the boundary or get accomplished what they want to accomplish. So a lot of questions and things came out when they really didn't give us a time frame. So fortunately, this is what I'm leading to. In 2008, the IRS gave us a safe harbor that was very specific to residential investment properties, not commercial, but residential investment. And they gave us three things to do if we don't want the IRS to ever audit or question how we used the property we were selling in a 1031. And these are the three things that they told us. Number one, if you want to sell a residential investment property and make sure it qualifies for a 1031, own it for at least 24 months. Okay, that's the floor. You can certainly own it for a lot longer, but 24 months minimum. So let's take those 24 months and let's turn those into two 12-month periods. And the IRS says, number two, in each 12-month period, you want to make sure that you rent that property at fair market rent for a minimum of 14 days. That's the floor. You can rent it for a whole lot longer if you want, but a minimum of 14 days. So 24 months, each 12-month period, minimal rental of 14 days, fair market rent. And this is when people usually get excited because they're already thinking ahead. They're like, okay, so you're telling me I can live in it for the majority of the year and all I have to do is rent it for 14 days? Nope, I'm not saying that at all. And the IRS isn't either. So this is what they said, the third thing, which is personal use. The IRS said you were limited in your personal use of that property to either 14 days or 10% of the time in which you've actually rented the property, whichever one is greater. So if I rented that property for 300 days out of the year, I would have 30 days of personal use. 10% of that time is 30. It's greater than 14, so I get the 30 days. If I rented it for 14 days out of the year, then I would have 14 days of personal use. So again, 24 months, rental of 14 days each 12-month period, and I make sure to keep my personal use limited to what the IRS allows. And they said, you do that with a property you're going to sell and it'll qualify for a 1031. We're not going to question it. So let's go right back to your question. What applies to the property I'm selling also applies to the property that I'm buying. So when I buy, let's say I'm selling land, farm, whatever else, and I go down to the beach and Abigail and I find the perfect beach investment property that, you know what, after a couple of years, yeah, I could see us moving into and having that as our primary residence. Then what the IRS said is when you buy that property, own it for 24 months, rent it for a minimum of 14 days each year that you own it, and keep your personal use limited. And after you do that, then you can convert it from a qualified use property, being that how you used it in those past 2 years, to now a non-qualified use, which is second home, vacation home, primary residence. And that is not a taxable event when you convert it. It's only taxable when you sell it in a taxable transaction. So when you're working with clients who, if they're brave enough to share with you what their 5-10 year plan is and kind of where the family is and where they'd like to be, hey, listen, I'm at A, I'm trying to get to C. How do I get there? A 1031 can be a part of that, and it can be a part of selling an investment property, buying an investment property in the ideal location that later on in life they could convert it over to a primary residence for personal use. So that's the three legs to the stool of how do we make sure the IRS is okay with our residential investment property sales and making sure they're a 1031. Any questions? But I know that's a lot. It's a big chunk. Any questions or thoughts about that piece? Okay, good. And I want to tell you why that's good, because a lot of the folks that I talk with will go, okay, Matt, let me ask you this. And I'm like, okay, all right, I know it's coming. How does the IRS know if I'm in that house for 14 days or 20 days? Or, I mean, how do they know? And if any, I'm not going to have you raise your little computer hand, but if you've ever been through an audit, you know what the IRS can find out. They can find out anything they want. So I'll just say from CPA, their lips to your ears. Number one, the IRS can pull the utility records for a property. Now, how much electricity and water was used? Matt, a lot was used this week. Who was there and what were they doing? Number two, Matt, I pulled your credit card bill and I saw that you and your wife bought groceries down at the Piggly Wiggly right next to your vacation property or right next to your investment. Where were you staying when you were down there? And believe it or not, here's the third one. Matt, I saw the most wonderful pictures of you and your family on Facebook down at your property. Were you staying there that night? What were you doing there? So again, there's nothing wrong with doing things right. And I think that's when we look at the rules and regulations of the 1031 and what's possible, nothing wrong with doing it all right. I like to sleep well at night. I don't like to think the IRS is creeping up on me or trying to get away with anything. But we have wonderful, wonderful rules that allow us to do amazing things with planning, with the right agent, with the right attorney, with the right CPA, and the right qualified intermediary. All these things are possible, and you can do them without worry, which is very valuable, I think. So let's talk about a couple of pain points. And let's talk about the process of how does somebody get started with a 1031. And let me tell you a couple of, everybody loves horror stories, and especially when it's not their horror story, when it's somebody else's. So a very sad call that I get is when a client calls and says, hey, Matt, I want to do a 1031. And that's not the sad part. That's a great part. I love that. And I'll say, okay, well, when are you closing? And they say, well, we closed yesterday. And I'm wise enough now to say, okay, now do you mean that you signed a contract yesterday, or were you at the closing table yesterday? Oh, no, we were at the closing table. And I unfortunately have to give them very bad news and saying, I'm very sorry, I cannot work with you on this transaction. And this is the reason. The IRS says that a taxpayer to start a 1031 must have an exchange agreement with a qualified intermediary in place, meaning signed and dated by at least the closing table, okay? And for those of you who have been through a 1031, whether you knew it ahead of time or whether or not you discovered it once you were in that 400 email chain between the paralegal and everybody, and all of a sudden you see this qualified intermediary involved, or you look at the HUD statement and all of a sudden your seller is no longer your seller, it's Investors Title Exchange Corporation as qualified intermediary for your seller. Then that's exactly what needs to take place. The whole reason that we're even created and a part of the process is your client cannot have constructive receipt of the sales proceeds from their property if they want to do a 1031. And that's why when closing takes place, generally you'll see somewhere down on the HUD on the dispersal side, funds to so-and-so qualified intermediary, and the proceeds from sale will go directly from the closing attorney's escrow account over to the qualified intermediary. The old monopoly things, since we're on the monopoly theme, don't pass go, don't collect your $200. It cannot touch that taxpayer's hands in any way, shape, or form. So that's why we need to have that exchange agreement in place, signed and dated by the closing table. Okay. So that's pain point number one, making sure that the client, if they ever mention 1031, if they don't bring their own qualified intermediary and make that introduction to you, as soon as they say anything about a 1031, number one, have they talked to their advisors from the tax perspective, and who are they talking with that's going to serve as qualified intermediary? Two very important questions that you can ask them to kind of get their wheels turning. Okay. So let's say we've closed, okay? Exchange agreements in place, everything happens wonderfully. We close on the sale of the piece of that property. That day is the day that we have 2 time clocks begin to tick. And that first time clock that we're very, very concerned with, and I don't mean concerned in a bad way, but what we're really focused on is the 45-day identification period. And what the IRS has said is if you're a client who is trying to do a 1031, then you have 45 days from the time that your property closed to identify potential replacement property, the properties that you may want to buy to complete this 1031. Now, the interesting thing about these 45 days is they're not business days, okay? They are true calendar days. So Saturdays and Sundays and holidays, rainy days and Mondays, we're on vacation days, the kids are sick days, I just don't feel like looking at anything today days, they all count in that 45-day identification period. So when we're waiting on a check, 45 days can seem like forever. But when you're trying to find property that's suitable to possibly purchase and own and then complete your 1031, it can go by pretty rapidly. So I would say from the agent perspective, if I had a client who I knew was considering a 1031 or was under contract to sell and really thinking about it, I would go ahead and start looking at properties with them. Even though those properties may not still be on the market by the time they actually have to identify, but at least if you don't know them already, or if they're not an investor and they already kind of know what they're looking for, you can go ahead and start helping them get an idea of okay, where are we looking? What are we looking for? What are your expectations out of a piece of property? And that way you can go ahead and start showing them things and they can have an idea to make that 45-day identification period that much easier. Now, a common question that I would get is, okay, Matt, must a property be under contract to officially be identified in that 45-day period? And it does not have to be under contract to be identified. However, would it be helpful? Potentially so. Certainly, it might be helpful because we know that properties come on the market and fall off for a myriad of reasons that you know better than I do. So it's great to have an idea and be able to identify quickly if possible, and certainly go under contract if feasible, okay? Now, during that 45 days, it's very fluid, meaning if I identify a property on day 2, and for whatever reason, I no longer want to identify that property, I can call that property, that's no problem. I can add properties to, take properties away. I can do anything I need to do on that identification until midnight of day 45. Once midnight of day 45 hits, chisel whatever they've identified in stone, because they will have to buy at least one of those properties if they want any tax deferred treatment. So that 45 days is very, very, very crucial. And this is why I think it's even more important to know about the 45-day pain point. Number one, We're in the business of solving pain points for people, whether they realize they have one or not. And your having knowledge of that 45-day period can help them solve something, because let's say somebody gives you a call just out of the blue. Let's say it's just me, okay? I don't identify myself. I just call you and I say, hey, listen, I'm on day 42 and I need your help. And if your response isn't, Matt, what, you don't know my name yet. Hey, caller, you have 3 days left before your 45th day. I'm getting ready to send you an email, or get dressed. I'm coming by your house, and even though I don't know who you are yet, I'm picking you up and we're going to go look at some property together. Okay. If that's not your response, then I don't know if I've called the right person. That's all I'm saying. So helping your client by understanding how important that 45-day identification period is crucial, I think. Any questions on 45-day chat? Unmute, whatever you need.
Matt, I have a question.
Yes.
So if you have a client, they have a property that's under contract to sell, and they're in the process of identifying their next property. And they identify a property, but the only way to buy it is to purchase it with cash in the next, let's just pretend 5 days before their current property is going to close. How does that, does that mean that this new property is not going to qualify because they will have purchased it themselves without the funds from their existing property?
You're exactly right. And here's the issue. And somebody mentioned a reverse exchange earlier. This is the issue with that scenario. The IRS said that you cannot use 1031 money to pay off or improve property for which you were already in the line of title of. So if they needed to have a quick cash close on that next property, then obviously, of course, they've come into the line of title on it, and that property should no longer be eligible for a replacement property on a 1031 on the property they're getting ready to sell. They would just have to go find a different property. Now, if it were truly a reverse exchange, which is a whole different animal. When we have this forward exchange we're talking about, right? We're selling property A and we go buy property B. But in the reverse exchange, we have two very distinct transactions. The first being, we would create an LLC. It would take assignment of the purchase contract of property B, the one they need to actually buy. And we would go to the closing table and we would buy property B for the taxpayer. Okay, that's transaction number one. We buy it, we put it into a parking garage, and we hold it for them. And we can hold it in that parking garage for a maximum of 180 days. So that's transaction number one. Transaction number two is what we're talking about right now. They sell property A they're already under contract with for the buyer. They sell it, they do a normal 1031, money goes to the qualified intermediary. And the property they're going to identify is property B owned by the LLC. And okay, now here's the catch. I left out the really hard part. The hard part is the LLC that we created to buy property B has empty pockets, okay? If I could form LLCs that already had money in them, I'd do that all day long, okay? So they have no money. So either the taxpayer needs to lend the money personally to the LLC so it has money to buy property B, or they go out and work with a bank, a hard money lender, whoever it might be, to make a loan to the LLC for enough money where they can buy property B and secure that ahead of time. So it's possible. Those reverse exchanges take a little bit more time than a standard forward does. And issues can pop up because banks are often very uncomfortable with the financing side if the taxpayer doesn't have funds on their own. But it's very possible, and it's good conversation. We can walk through it and really talk with the client, with you, and with the bank about how it would function, how it works, show you all of our paperwork. When a reverse exchange is needed, it works beautifully. 5 days to get one done, we'd probably all be sweating. to make sure it can happen within 5 days. So much has to take place, but very, very possible nonetheless.
Matt,
Yes.
I do have a couple questions. So I'm fairly new to the 1031 exchange process.
Mhm.
Who puts the agreement together? Is it the qualified intermediary? And the other question I had is, how do you identify like once you find the property, how is it identified? Do you go through the qualified intermediary?
Thanks, Jay. Two great questions. Number one, yes, the qualified intermediary is going to prepare the exchange agreement for the 1031. Everything else with the closing is still going to stay the exact same. We're just going to submit an additional bunch of paperwork for everybody to sign, basically, okay? So, but it will come from the qualified intermediary. The taxpayer or your client will engage with us directly to do so. Generally, I mean, we have an order form that would take 2 minutes to fill out. That with a copy of the sales contract is all we need to get the exchange agreement completed and emailed out to everyone. So that's number one. Exchange agreement would come from the qualified intermediary. Number two, as part of that exchange agreement, Jane, there's going to be an identification form, and we just do that for convenience. It doesn't have to come on our form, but basically it'll say, here are my identifications. And from an identification standpoint, we like to see a very detailed identification. So what we don't want to see is a house in Raleigh. That's not going to work, okay? So I like to see something that we might see on the contract. 123 Smith Street, Raleigh, North Carolina, tax map plat numbers. If it's a condo, so-and-so condo, building 5, unit 13, very, very specific. And the qualified intermediary would like to have that in writing, signed and dated, okay? And we need to receive that again, Jane, before midnight of day 45. So that can come directly from us, and that identification can come directly to us.
Okay, thank you. That answers
Very
my
well.
question.
Great.
We've got a few hands raised, so we're going to start
Yes.
with Brian, then we'll go to Darian, and then we've got one in the chat. So Brian,
Excellent.
Real quick, going back to Alex's question about what that led to the discussion about a reverse exchange. I assume then the taxpayer cannot just form their own LLC to purchase the property and later buy the property from their LLC. Is that correct?
That is mostly correct. Yes. It really depends on how that LLC is structured, if they would be considered a related party to, or if it was what can happen with the IRS should they audit it. They can actually collapse a transaction and say, okay, here was the real intent. You went and did this, and the only reason you did this was to avoid tax. And so we're going to collapse those transactions and put them into one. I have certainly seen friendly parties go out and buy a property for someone else so that it could be held as the other party's eventual replacement property. But again, you know, is it arm's length? What was the financial benefit to the one who held it? Those things may be considered should the IRS ever audit that transaction. But Brian, I certainly have seen that, and usually we would quickly push them back to their attorney and CPA to say, listen, you all talk through this, make sure you have a comfort level with what needs to happen, then come back to us and let's talk it through.
Okay, perfect. That was my second question, was just related parties, but I guess that answers that. There's not a black line you can draw for me on what the IRS will deem acceptable there.
Not really. And from the related party side, however, related parties are just the IRS gets a little wonky on related parties being involved in an exchange. And I'll give you a couple of examples. Let's say that my brother owned a piece of property that I wanted, and I owned a piece of property he wanted. And so we can do a direct swap of properties and it still count as a 1031. So I give him my property, he gives me his property. Since we're related parties, the IRS said he has to hold the piece of property for 2 years, and now I must hold that new piece of property for 2 years as well. Okay. The IRS is fine if I sold a piece of property to my brother and I did the deferred exchange and I bought a piece of property as my replacement from an unrelated party. Not a problem at all. The other problem comes in when I sell a piece of property to an unrelated party. I do the deferred 1031 and I go buy property from my brother. The IRS will not allow that in any way, shape, or form, except for if my brother was selling me the property and he in turn was also doing a 1031 into something else. That the IRS is fine with. What they're concerned about is shifting basis between related parties, which is a tax avoidance. I don't say scheme, it's a tax avoidance possibility. So the IRS is really sensitive on that. And related parties are grandma, grandpa, mom, dad, spouse, brother, sister, children, not first cousins, not aunts and uncles, not in-laws, but it's also business entity. So do I own 50% or greater of an entity, or do I and a related party combined own more than 50% in an entity? So all of those can be considered related parties, and they're very contentious issues that need an advisor involved in case there are swaps between families and family members and entities.
So much nuance. Thank you so much.
I know, right?
Darian, what you got for us?
So a couple of parts. I have a client that just used a 1031 actually last month to purchase a property. She's selling another property that her property, that closing is tomorrow.
Okay.
We've already identified a property that she wants to purchase. Can you put in an offer, a contingent offer, and still use a tax 31 exchange before that other one closes? That was kind of the first part. The second was, this will obviously be well within that 45-day range, but let's say that falls through, or you identify a property within 45 days, and for some reason you don't win the offer on that property. Does that 45-day period continuously reset when a property is identified? Is there a limit to that, or are you out of luck at that point?
Gotcha. Okay, so nothing wrong with putting a contingency on a piece of property. You know, whether that is just an all-out contingency and the seller agrees, or if there needs to be additional monies, due diligence, earnest money, whatever needs to go to make sure that that order stays in, I'm selling property A and I'm able to buy property B. So contingencies are perfectly fine. Now, the issue with the 45-day. Okay, let's say that we made an offer, and as Darian said, within that 45 days, the offer was not accepted, or we find after the 45 days that the offer was not accepted. And now that one property that I identified is no longer, I can't close on it. It's just impossible. Does the IRS have a heart? No, they do not. Okay, so the only time we have an extension of the 45-day identification period is something that we don't want to happen anyway, okay, which is a presidentially declared disaster. And we've had 3 of those in North Carolina, last year, between hurricanes and floods. So that's the only time. And usually those come out, if you're familiar with them, they come out county by county. And the Treasury will eventually release a letter that says, listen, if you're in one of these affected counties, then here are your new tax filing due dates, here are your deadlines. And that is the time when the Treasury may push back the 45 and 180 days if you live in, or the property you were selling was in one of those affected counties. That's the only time. So if I identified a piece of property and on day 47, the property burns down, the IRS doesn't care. On day 47, the property owner dies. Now we're in probate. There's no way in the world we can get this thing closed within my 180-day schedule. The IRS has no heart for that, okay? What they did provide us was the ability to identify multiple properties in that 45-day period. And there's 3 different rules, but the most used rule is the 3 property rule, meaning I can identify up to 3 properties as potential replacement properties. And for identification purposes, the IRS doesn't care what the amounts far as the values of those properties go. They're just talking about how many. So I can identify 1, 2, or 3. So if I'm selling property A, and I know for a fact that I want to buy property B, maybe if I was this client's agent, I would say, listen, we can go identify 2 other properties. So just in case we can't close on property B, and to be as prudent as possible to make sure your 1031 can be completed, can we go out together and find at least 2 other properties that you might be comfortable with possibly purchasing to complete your 1031? So we can have property A and we can have 2 backups. Or what if you're working with a client, a true investor who says, listen, I want to take the equity from my sale and I want to put a 30% down deposit, 30% deposit down on multiple properties. Okay, I'm selling one and I want to buy 5 properties. Is that possible within the 1031? Absolutely it is. We still have identification rules that can fit that model. So the identification is wide open. It does have some either number of properties or a value of properties. And I'll send all this information, Kate. I'll send this to you to send out to everybody that kind of goes over these rules and stuff. And you can always call me or text me or email me and we can walk through things. But there is some ability to identify multiple properties for that 1031. So they're not locked in just to one.
Thank you so much. Definitely look forward to getting all of that because I know we
Yeah.
are all eagerly taking notes and we'll be watching this recording back, but I know there's so much to learn. So I'm going to hop over to the chat for a few questions. Gina asked if you could please provide the language that we should include on the offer to purchase or the listing agreement. Is that specific to the 1031?
It is, we do have some suggested language. It is boilerplate in both contracts in North Carolina on commercial and residential. But if you have an OTP or something where you want some language, I have that, and Kate, I will email that over to you for everybody as well.
Amazing. The second question is actually one I'm going to piggyback off of because my question is similar to it. Julie was asking about the DD fees. She says, it's my understanding that the qualified intermediary should be the person who receives the DD fees on the seller side of the 1031 exchange. Is that correct?
It can be correct. And due diligence on the sale property can be handled one of 2 ways. In general, the qualified intermediary will not want to hold due diligence money until they have an exchange agreement in place and they have an assignment of contract signed and dated by the client, which would then give us the right to hold the due diligence. Okay, so that's number one. If they have an exchange agreement in place and assignment of the contract has happened, then the DD comes in, the taxpayer can send it directly to the qualified intermediary, or the buyer can have the due diligence sent directly to the qualified intermediary.
Okay.
What normally happens is this. What we would say is a couple of days before closing takes place, let the paralegal know, listen, I've got $5,000 worth of earnest money or due diligence in my bank account. The taxpayer can hold that money, but they need to make sure that they call the paralegal and say, listen, I've got $5,000 worth of earnest money. I need to wire this money to the escrow account, and I want this $5,000 included in the proceeds to go to the qualified intermediary for my 1031. Because the closing hasn't taken place yet, that money is not deemed as being held in a constructive receipt capacity. If they're still holding the $5,000 after closing takes place, then they're in constructive receipt of it. So again, exchange agreement signed, assignment of contract, one of the forms of that exchange agreement signed, qualified intermediary can hold the DD. Otherwise, taxpayer can hold it before closing takes place, have that conversation with the closing attorney and paralegal saying, I've got X amount of money. I need to wire this to the escrow account. Make sure that happens. They can include that in the total proceeds that then come to the qualified intermediary.
Wonderful. And so I'd actually like to also talk about the buy side. The question that I had also with relation to deposits is you mentioned that the they can't touch that money, right? Like once they sell one property and they're headed to the other. So does that mean that the person who is purchasing the next property needs to have the cash on hand for any deposits that they need to make on that upcoming property?
So
Since
in general, again, if we're assigned that contract of purchase, then we can generally distribute out earnest money or due diligence directly to that closing entity's escrow account ahead of time as necessary. Again, we just want to make sure that paperwork's in place. We have the right to send it out for that next transaction. Now, what we would not want to do is send any money out from the qualified intermediary account to non-qualified expenses, meaning, if there is a fee from just as an example, if they're financing that next property and the lender requires a fee directly related to financing, the qualified intermediary should not release any money to that lender. That is not a qualified expense. It does not count in the 1031 funds, and that would be considered constructive receipt. So the QI, the qualified intermediary, is limited and the reasons that they can send money out for that next property, but certainly putting a deposit down is not one of those. We can do that with the proper assignment.
Wonderful. Thank you. Darian, you have another question.
With the due diligence going directly to the buyer, not being held in an escrow account, I don't know what issues you've had with that, but I know with my last transaction, it may be because it was an out of state 31 tax exchange management company, they may not have been as familiar with due diligence, but they would not wire any funds to the seller. They would only mail them, and for some reason, they just sent them regular mail. They didn't even like overnight it or put a tracking on it or anything. It was insane.
Yeah.
So it didn't. It did not get there. Like it was 2-week closing or like a 10-day closing or something like that. So it didn't get in time. The seller was really cool about it. We just ended up working out the contract and doing the credit. They canceled the check. So it worked out. But is that what I should expect? Is that typical?
Well, let's just say that, okay, let's have a different discussion, but let's hit the same idea. Is one broker different from another? Is one agent different from the other in how they operate and how they work? Of course they are. And it's the same in the qualified intermediary world. And I just want to ask you this question, because this is a good thought for Darian, when you're working with a client with any qualified, there are many wonderful qualified intermediaries out there. I know a lot of them. They're great people, get along with them very, very well. But what makes a qualified intermediary qualified? I'll open the floor. What makes a qualified intermediary qualified? Somebody take a chance.
I feel like it means that you specialize in this, right? Like it's not typically your average attorney, first of all. Like it's normally a company like yours that specializes in this.
I would say in general, you're right, but has nothing to do with being qualified. Okay, I'll
take a class.
Most of us do, but no, does not mean you're qualified. All right, so here's what makes a qualified intermediary qualified, and it's not actually two things they are, it's two things they are not. Okay, so first, a qualified intermediary cannot be an agent of the taxpayer, meaning they cannot be a CPA, attorney, broker, agent, anybody who's done work for that client in the past 2 years. That's number one. Number two, they cannot be a related party. Again, related party comes back into the deal. Cannot be a related party to the taxpayer. So if you're not those two things, you, my friends, can be a qualified intermediary too. Okay, so we can go to the absurd side and say, walk out of your house or office and go to the street, stop the next car and ask them, are you related to me? No. Have you done any work for me in the past 2 years? No. Would you be my qualified intermediary? Would you hold my $750,000 for me while I go find a new property? So not every qualified intermediary is the same. Not every qualified intermediary focuses solely on 1031s, and not every qualified intermediary is an attorney or a CPA or a title company. So there's others out there. Again, that's not disparaging them in any way, shape, or form. It's just a matter of that doing your due diligence on your qualified intermediary, to me, is as important as vetting your investment person, your banker, the attorney you're using, the CPA you're using, the agent that I'm working with. I want to know who you are. How many transactions have you handled? What's your specialty? What's your market? Do you have an asset class that you specialize in? What can you tell me? Those are the things. So when Abigail and I do 1031s, I can't use our company because I work for them. Okay. So I have to use another QI. And I want to know the same thing. How many transactions do you do a month? Now, this is not my own personal market research. It's just personal. How many do you handle a month? What are your fees? Who is on staff? Where is my money held? How is it held? What protections do you have in place? What insurance do you have in place? When I call, do you answer? When I email, do you respond? How do we work through due diligence? Do you like to wire or send mail? A lot of people are freaked out about wiring things right now. They're just uncomfortable because there's so much fraud out there in the marketplace. What processes do you have in hand to make sure that you're wiring to the right people? I think so. That's why I'm trying to kind of go with that. Not that they did anything wrong, but if they knew the immediacy of that check, did somebody just not pay attention, or is that their normal protocol for sending out just regular mail? I don't know. But when small things are dropped, they could have big consequences, because what if your seller, Darian, went, yeah, you didn't make it. Sorry, the rules are rules. Our agreement's our agreement. So it's important. And especially when you say, Matt, I just want to make sure my money's there, so that when I close on a piece of property, it's there in that escrow account so I can actually close on it and take title to it. So money security is huge. And, experience, where are you? What states are you used to operating in? Because honestly, federal level is federal level. It covers all 50 states. Each state may have its own little unique perspective on 1031s, or they might have withholdings. If you're a non-resident in South Carolina selling property in South Carolina, buying outside, they have a withholding, but there's an exception there. Maryland is that way. Delaware's that way. California has an issue with the franchise tax board. They have a clawback provision. When you sell a piece of property in a taxable transaction, 20 years later, California's going to go, I want my tax back. So there's state level things that I think a qualified intermediary should also be familiar with that can be of great help to your client. FIRPTA is one of those things. What if you have a non-resident who is selling investment property in the U.S.? How does that work with FIRPTA and a 1031? All these things are very crucial, knowing that you're working with the right qualified intermediary. So during that's why a long-winded, boring way of saying, everybody operates a little bit differently. A great thing to ask ahead of time: how do you handle disbursement of due diligence and earnest money? And due diligence, people aren't that outside of North Carolina, not that familiar with it.
Thank you for answering all of our questions, Matt. I'll give it just a few more minutes as we're pushing up against time. If anyone has any remaining questions, pop your hand up or put it in the chat. I figured, based on what you just said and one of the questions that I have in our DMs, I know on the front end we didn't quite do an introduction or you introduce yourself. So obviously we know who you are and who you work for, but are you a CPA? Are you a lawyer? Where do you fall in terms of what is a qualified intermediary? And tell us a little bit about yourself. Obviously, we've learned a lot from you today. We'd love to know you more personally.
So from the 1031 perspective, this has been my professional passion for almost 25 years. I'm not a CPA. I'm not an attorney. When I got out of school, I started with Wachovia Bank in downtown Winston-Salem. And when they opened up their qualified intermediary, that's where I got my start. And so every day I spend talking with CPAs and attorneys and taxpayers and agents and brokers about 1031s, teaching continuing education, also walking through specific situations and kind of helping them understand the general rules and responsibilities from the 1031 perspective. I am a certified exchange specialist. That is the only designation that you can get within the 1031 world. In our office in Chapel Hill, we have 17 people that are fully dedicated to 1031 like-kind exchanges. Of the 17, we have 3 attorneys on staff. We have 6 certified exchange specialists. And the reason I say that is there's less than 150 in the United States, and we have 6 of them in our office in Chapel Hill. So we do know 1031s. We handle hundreds of exchanges every single month. Very few things ever end up surprising us. People often can be surprising, but you know, the deal, the 1031, very few things ever come up that are surprising. And so what I offer is just my availability. You can call, email, or text me. And what I always say is whether it's a holiday or Saturday or Sunday, because real estate is 8 to 5, Monday through Friday, right? No weekend work, no night work, no nothing like that. So nobody ever asks you a question on Saturday about 1031s. If they do, I will answer your call, your email, and your text until Abigail knocks the phone out of my hand. Okay, that's my promise. But again, we are a title company. We do residential, commercial title. We have escrow services for the commercial side. And yes, we have this 1031 group that has been operating since 1988. So we have vast amounts of experience in working with clients across the U.S. We know the nuances that can happen within the states. And all of that's great. But for you, I would say that if we're not the best on customer service, then we're tied for first in the U.S. We pride ourselves in making sure you get responses when you need them and responding to your client when you have enough confidence to send them our way so that you don't lose confidence with us or face to them.
Absolutely. And I can attest to that, Matt. You are so passionate about what you do. You're always available. If you send an email to him, it's not surprising if you get an autoresponder saying he's doing stuff like this, but he still will respond right away, back to back with that. So we will take one more question. Jane, I'll get to you in just a second. We'll take one more question, but please know he is here to be a continued resource to us. Matt has been in our orbit for years. He actually did this session for us years ago. And so just like we believe at Choice, he believes that knowledge deserves to be shared, and he is a resource that we value dearly. So Matt, thank you. Jane, why don't you finish us off? What question do you have?
Okay, so quick question. I have an upcoming transaction where the property they've already sold. And so we're going to be looking for new properties. And my 45 days is already ticking, so that was good. When we're ready to write the offer, the earnest money and the due diligence money then is coming from the QI. Is that correct?
It certainly can. It can come from them. Again, you want to talk with the qualified intermediary and understand what they will require to make that distribution out. Okay, so talk with them just to make sure. And then again, second, it depends on the amount of property that they're buying. So let's say if they have 200,000 in their qualified intermediary account, but they're buying a property for 400,000, then that money could certainly come out of their pocket if they had the ability to produce it to go towards that next property. So number one, just check and see with the QI what they require. And number two, if it's better from the taxpayer standpoint for convenience or anything else for that to come out of their own pocket, either which way.
Thank you.
You're very welcome.
Wonderful. Well, thank you, Matt, so much. I know we said it already, but if you guys have any questions, feel free to reach out to him. Once this recording is ready, we'll send it out. And as always, when we do that, we'll be sure to include Matt's contact information. Thank you for showing up today and continuing to be a resource to not only your clients, but to yourself so you can continue to evolve your business. Matt, thanks so much for your time. So helpful.
Thank you, Kate.
Have a great day, everyone.
All right. Bye-bye, everyone.
Bye.